currently is increasingly volatile. Western nations are becoming more and more protectionist with the far right shift in Europe, in America right now. There is heavy anti-developing country rhetoric in a lot of these countries right now. Tariffs have hit the countries within BRICS pretty hard, especially. At this point, they need economic cooperation and viable alternatives to have some amount of bargaining power. Otherwise, they risk falling to things like loans, etc., which are pretty bad for your economy, right? Moving on to then first argument just on hegemony. You're able to go ahead and reduce dependence on the dollar, right? For stuff like trade and for the value of reserves, which means you reduce the concentration and power of the hegemony that the United States holds, which means that you can uniquely go ahead and protect yourself from increasingly volatile policies like tariffs, etc. But secondly, you also reduce vulnerability in American economic decisions. That is to say, if Trump makes a bad decision today, the impact on worldwide economies reduces if you have a BRICS currency, because they're not as much dependent on the US dollar for trade, which in the status quo is the currency most countries use for intra nation trade, right? But thirdly, when you have a common BRICS currency, you have a lot more bargaining power, which is to say that countries like India and China can now go ahead and set themselves up as like counterweights to the IMF or World Bank, which directly means you can go ahead and ensure that there is a Eastern influence as well when you're making these critical decisions, and it's not just about the European Union and the United States anymore. But secondly, you're also opening up a platform for global South countries and their influence that goes directly into international policy making. You can go ahead and set up rules and policy that are more equitable globally. Now, why is this important? Because A, your global economy is stronger and more stable because you're no longer susceptible to shocks caused by a single country. But B, we think you also have a lot more competitiveness because when multiple countries can now go ahead and compete with the United States, and there is a shift in this monopoly, you have a lot more countries with growing industries. You see a lot more domination by Asian countries as well, which means you see stuff like more innovation. But thirdly, we think there is more development across the global South because you now have more places where you can go ahead and invest. But also note, panel, that all impacts here are exclusive because until a BRICS currency comes into place, the alternative is just that the American dollars continues to be the most powerful currency. There is no single country in the status quo with the hegemony to go ahead and flip that and bring that change. But now, secondly, on intra-BRICS relations, right? Firstly, it is easier for countries within BRICS to trade within another. Because it is easier for Brazil and South Africa, for example, to trade without facing millions of bureaucratic hurdles, such as currency conversion, etc. You can go ahead and lower transaction costs and make it a lot cheaper for countries in BRICS. But secondly, countries within BRICS build better ties with each other. That is to say, since India and China will share currency, some amount of currency reserves, go ahead and have some amount of their economies tied to one another, the incentive to go ahead and attack each other or pick conflict with each other reduces, meaning that countries within BRICS build better ties and have more sustainability. But thirdly, when you have a collective currency, at least for trade in the short term, you're able to go ahead and offset the fall of one currency. So as BRICS continues to grow, small developing economies within BRICS, which may have weak currency due to bad economic policy, can go ahead and offset that. But fourthly, small countries don't lose on export competitiveness, right? Because they can go ahead and do things like export natural resources that they have, and stability means you have more consistent trade, etc. So this is of net good to the most vulnerable nations. Why is this so important then? Because A, at the point to which BRICS is strengthened, you're able to ensure some of the most growing and strongest economies in the world are strengthened, which just means that you have better trickle down for the rest of the world, especially in the global South. But B, you're able to ensure that a lot more smaller countries in places like Asia and Africa and South America can now go ahead and develop, right? You end up strengthening economies worldwide as well because you see less conflict. More in this in second, where they'll tell you why our cases stand alone and why we are so proud to propose.
Perfect. I thank the speaker for a very fine speech. I welcome the LO to start the case from the opening opposition. Here.
Can you hear me?
Yep, loud and clear.
All right. So I'd really appreciate it if you guys can leave your POIs on the chat, and I'll try my best to answer them, okay? So I'll start my speech in three, two, one. Instead of adopting a common currency, we on opening opposition want to highlight alternative policies that BRICS has already been pursuing, which OG just stated themselves as per economic cooperation, which are far more realistic and effective than currency unification. For example, the BRICS contingent reserve arrangement is a $100 billion pooled reserve designed to provide emergency liquidity support during balance of payment crises. This mechanism already strengthens the stability and offers protection in times of financial shocks, precisely the kind of function a common currency is supposed to address without forcing member states to surrender their monetary sovereignty. Our first argument is then grounded upon extreme economic divergence. So here's our premise. BRICS members have fundamentally different economic structures, development levels, and vulnerabilities. Just look at their inherent structural differences. China dominates the bloc, producing nearly half of BRICS GDP through an export-led, manufacturing-heavy model. India, by contrast, is service-driven and domestically focused, nearly 80% of its labor force in the information sector. Russia and Brazil rely heavily on volatile commodity exports such as oil and gas, while South Africa struggles with chronic unemployment and stark inequality rooted in apartheid-era legacies. Additionally, policy divergence, specifically inflation and fiscal stability, vary widely. Brazil and South Africa often struggle with double-digit inflation and fiscal imbalance, while China maintains tighter controls with stronger reserves and centralized policymaking. This means monetary responses needed in one member state may directly harm another. Also, policy mismatch risk. If inflation spikes in Brazil or South Africa, a BRICS central bank might raise interest rates to stabilize prices. But this will not only stall but destroy China's manufacturing growth and India's services sector, causing layoffs and reduced competitiveness, which dismantles OG's claims that exports will not lose global competitiveness. Conversely, monetary loosening to stimulate Indian demand could worsen inflation in South Africa as well. So here's the impact. Any unified policy must be disastrously mismatched for at least some members, resulting in unemployment spikes, lost competitiveness for exports, or deepening recessions in the most vulnerable economies. This divergence would erode support for the common currency, pushing members towards exit or non-compliance, undercutting the project's viability. Our second argument is rooted upon the political rivalry and governance gridlock. Our premise is very, very simple. BRICS lacks the trust, cohesion, and institutional alignment required to join monetary governments. Let's look at the facts. India and China have unresolved border disputes, clashing interests in South Asia and Africa, and competing visions of global leadership. Russia and China often push anti-Western strategies, while India leans towards Western partnerships, fractures that make consensus fragile. Also, China's economic dominance raises fears that BRICS monetary institution will become Beijing controlled. Smaller states would resist ceding to sovereignty to China, leading to veto standoffs or watered down agreements. Here's the historical precedent. Even the Eurozone was nearly derailed by the Greek debt in 2010. BRICS, with a far less institutional trust and more divergent political systems, would face magnified gridlock. Most importantly, in moments of crises, BRICS members would disagree on how to respond, paralyzing decision making. For example, India and Brazil may oppose policies that deepen their exposure to secondary sanctions while China and Russia push confrontation. The impact is clear cut. Policy deadlocks, lack of trust in shared institutions, and fear of domination by the largest member, which is China, would continually undermine market faith and political willingness to abide by collective decisions, increasing the risk of breakdown in crisis moments. Our third argument is based on loss of monetary and fiscal sovereignty, and here's the premise. A common currency strips states of its tools to respond to domestic crises, amplifying vulnerability. Members can no longer adjust exchange rates or interest rates independently to fight inflation, unemployment, and financial shocks. And here's a crisis scenario. If oil prices collapse, Brazil and Russia could not devalue their currency to restore export competitiveness. In fact, if inflation spikes in South Africa, it would not tighten policy without BRICS-wide agreement. And here are the historical lessons. Greece, Spain, and Portugal all suffered prolonged recessions during the Eurozone crisis because they could not devalue their currency. Instead, austerity was imposed, leading to mass unemployment, poverty, and social unrest. And here's the impact. Public backlash and political instability would rise as government become powerless to protect their citizens from economic distress, potentially sparking financial crisis and exit referendums. And here's our last argument, geopolitical backlash and external vulnerability. The premise is very intuitive. Moving away from the dollar would provoke retaliation from Western powers and destabilize smaller BRICS economies. The US and the allies could impose sanctions, tariffs, or exclusion from critical financial systems like the SWIFT in response to BRICS' challenge to the dollar. This risk is not hypothetical. South Africa already faced Western pressure for engaging with Russia during the Ukraine war. For example, even recently, President Trump threatened 100% tariffs on BRICS countries if they tried to undercut the dollar. South Africa risked Western retaliation for refusing to enforce sanctions against Russia, and the impact is detrimental. Rather than boosting autonomy, the bloc should become more vulnerable to global shocks, weakening the most exposed economies and deterring broader international participation. Thank you for listening.
Perfect. I thank Hello for a very fine speech. DPM whenever they are ready. Here.
Right, but am I clearly audible if I speak at this volume?
Yes.
All right, good. I'll take PRs only via chat, so please don't verbalize. On the top of the speech, I want to deal with O's entire case. Firstly, on economic cooperation, we just do not think this is mutually exclusive. Even if you're going to go ahead and develop like a common currency, you're probably going to go ahead and do like these secondary things anyway. So you're still probably going to go ahead and have like this sort of like a policy that they talk about to go ahead and collaborate and keep stability, especially when you have Trump, etc. What we then tell you is that this is really important for the long term, because not that we uniquely tell you that by having like a common currency, you're able to like do things like reduce transaction costs. You're able to go ahead and have like a better perception that leads to like capital inflight in the first place that you just absolutely do not get when a bunch of countries are just pooling together and you just get money directly from them. That is oftentimes just seen as akin to a loan or just like lending money in the first place. But second, what we would posit that like insofar as you do have like empirical examples like Eurozone, even if the Eurozone crisis did happen, Europe was able to go ahead and just like get over it, right? We still think that within like the EU as a whole, you have different countries of like different varied economic backgrounds, and you can probably go ahead and like negotiate an interest rate that actually works for you. And in case you are having like a heavy financial crisis that is going on within your country, I would posit that it's in the interest of all of these countries to go ahead and like reduce things like interest rates, because they obviously want you to go ahead and stabilize because it's a common currency. We would flip this. We would tell you that larger powers like China or India, for example, are now far more likely to care about things like Africa's fiscal health, etc., are far more likely to go ahead and invest within these countries to prevent that sort of situation from occurring in the first place. We would posit this as a net good for the people living within these countries who are obviously the most vulnerable. So we can actually flip this and then just easily weigh this out. But just look at the way you can go ahead and just like, this is going to be a basket currency. So it's not going to be pegged only to the Chinese yuan, but rather the culmination of all of these currencies. So it's far harder to have that sort of volatility and inflation that they talk about within the set. But also, just like we just think that economic crisis is already on the verge. So just like look at how apocalyptic the future is looking for a lot of these countries, and like just look at the sort of tariffs that they have and the sort of like and the sort of like alienation they're having from Western nations. We would posit that like Western backlash just absolutely does not matter within this round, insofar as that's going to happen on their side of the house. Insofar as they concede, you still have these cooperation measures on their side. Then what then happens on our side is that you have countries which actively have a stake in like determining your welfare, which actively have a stake in you being a stable economy, because obviously they're going to be affected by it. And we think that is the point at which you're able to reach the sort of mutual cooperation that they talk about. But the second thing that they tell you is that there's no trust between these countries. We would probably posit that this is unlikely, because you have to be on the same page to be able to go ahead and like fight America and just like protectionist policies as a whole, because otherwise they're going to get ruined. Just look at Russia. The reason why they're primarily volatile is not only because they're an oil industry, but also because they're being sanctioned by the West. They have incentives. All of the leaders have incentives to go ahead and cooperate, and I think they've empirically cooperated, and we assume that this sort of cooperation is possible in the first place, for to have this debate in the first place. So we do not think that this was a contention that they could properly make within this round. But second, note that we told you that this is going to be long term. That is, you're not suddenly going to go ahead and give your average Joe like a BRICS currency. This is primarily going to be for inter-BRICS trade in the first place, and then you go ahead and start things like domestic adoption after you're able to figure out all of the logistics. We just think that there's a self-correcting mechanism when it comes to different countries collaborating. But if anything, we would posit that this probably makes cooperations far better, even if they're not perfect right now. We've already given you the mechanisms for this, and know that they did not respond to any of this. But I want to quickly weigh why we clearly won this round already. Note that our argument is of utmost importance to this round. We tell you why BRICS and the most vulnerable nations within BRICS are better off. Note that any argument that closing is going to give you cannot go ahead and compare to the same scale of impact here, simply because BRICS is just massive in terms of its population and its economic growth. And the US dollar hegemony pushes Trump to be a far worse actor because he's able to go ahead and bully smaller nations with the sort of bargaining power that the US has, just because the dollar is like the global the global currency of status quo. But we also tell you that the most vulnerable nations within BRICS are better off because like the transaction costs go down, but also just like the perceived stability increases. We think this was always a net good to countries like South Africa that just do not have really good funding mechanisms in the first place, and we just think that it's really good to go ahead and trade with them because they have lots of things like natural resources. But second, closing has to go ahead and prove a non-derivative version of how you get this broad social welfare, and has to go ahead and cater to scale and vulnerability. So incredibly proud to propose.
Perfect. I thank DPM for your very fine speech. DLO whenever they are ready. Here.
Hi, can you hear me?
Yep, loud and clear.
All right, I'll take POIs verbally. Oh, sorry, I'll take POIs by chat. All right, may I begin?
Yes, you can start.
All right, thank you. 3 things I'll chat about in this speech. First on OG's model, second on OG's arguments, and finally on our argumentation and preemptive weighing of this round. Let's start with OG's model. The first thing to point out is that backing a common currency with BRICS sovereign bonds or assets does not guarantee stability or trust, especially given that those assets also range hugely in quality and volatility. Do not let OG get away with this lie. For instance, Brazil and South Africa have fluctuating credit ratings and high inflation risks. Russia faces sanctions, which makes its assets toxic for financial markets. And China's bond market is not fully open or even trusted internationally. And as in the case of the Eurozone, if commodity backing is proposed through alternative means or resources like gold or oil, this will just amplify deflationary pressures and boom-bust cycles, which ultimately just makes macroeconomic stabilization even harder. The second thing to point out is that using the new currency only for quote-unquote inter-BRICS commerce is obviously unlikely to meaningfully reduce dollar reliance, which is the main winning angle from OG, as most trade for these economies is still with non-BRICS partners, which is settled in dollars. In addition, given how unclear this quote-unquote gradual transition is, the common currency with its limited convertibility and liquidity will obviously not offer a viable alternative to the dollar or euro for major commerce, particularly as settlement risks such as FX volatility, payment features, and low trust remains. OG's burden in this debate is not just to prove how this transition process will be gradual, but also why this currency will gradually be adopted and accepted over the dollar and euro, both of which they failed to do so in this debate. The final thing to point out is that even with a committee, real governance will likely be determined by things like economic weight, political leverage, like GDP per capita, where China's outsized influence is obviously given. They give you no structural mechanisms why all BRICS nations will have equal and voice within decision making. But also, as evidence in the Eurozone, we pointed out how disagreements between BRICS nations over factors like monetary rules, emergency responses, and contributions to any stabilization fund will obviously rapidly surface as interests diverge. And OG never clarifies how any of these risks will be managed by this committee. All this is already round winning, given that all of OG's case is entirely contingent on them proving that this common currency will work and will be managed well, which obviously their flimsy model has not done. But for the sake of engagement, I'll talk about their first argument then on how this will allow BRICS to combat the US hegemony. A couple of responses here. First, a BRICS currency would just only Western sanctions, tariffs, and capital flight. Smaller economies then, like South Africa and Brazil within BRICS, would collapse under these sanctions by the US. So instead of reducing US dominance, what happens realistically is that this just increases exposure. But second, only China and maybe Russia can withstand the US retaliation. And smaller countries within BRICS then doesn't benefit unilaterally or equally, which makes this common currency uneven and likely to be splintered and fragile because more and more countries will be pulling out with US retaliation. But thirdly, BRICS already has ways to hedge against dollar dominance, like we pointed out in our first speech, like bilateral currency swaps and the CRA, without having to bind themselves to a single vulnerable currency. Sure, maybe they get marginal increase in combating US hegemony, but this opening government team never proves to you why all of these hosts of risks and dangers financially and economically that can occur to many of these nations should be worth risking. Their next argument is on increasing development across the global south. What? Currency does not equate development. Infrastructure, education, and investment are factors that drive development, not a risky monetary experiment that OG wants to run. Because a common currency does not guarantee foreign direct investment or sustainable growth. They don't give you any mechanization here. What we can point to is a Eurozone precedent, where Greece and Portugal literally show us how a shared currency can actually stall development because countries can't devalue or set their own interest rates to recover from these downturns. Their third argument is on the efficiency of intra-BRICS relations. This also deals with their response to our second argument regarding how all BRICS nations are on the same page. Firstly, we already pointed out how there's a policy mismatch regarding how like China's export-heavy economy, India's service-driven economy, and Brazil's and Russia's commodity dependence, all of these differing demands lead to having different demands for different monetary policies. But secondly, we already pointed out how there exists existing rivalries and gridlocks, like China and India's border disputes and Russia's sanctions, which will naturally spill into factors like monetary governments, which makes decision-making gridlocked. We pointed to other better alternatives that exist, like the CRA and NDB, that do not require a one-size-fits-all currency system. The final argument is perhaps the most remarkably implausible, which is that this increases stability for small countries. Only one response is needed, that this actually causes a loss of sovereignty, that smaller economies lose the ability on their side of the house to devalue or change interest rates to accordingly deal with their nation-specific crises, which is their most important stabilizing tool in the case of economic emergencies. What is far more compelling then is our argumentation that is round winning. We give you two arguments regarding why this is implausible, but two arguments regarding why even if this was possible, this would be economically horrible. We point out to you why this will lead to extreme economic divergence and political rivalry and governance gridlock, which makes this unlikely to occur. But also, even if this were to occur, this will be unsuccessful because of a loss of monetary and fiscal sovereignty and due to US and Western geopolitical backlash and external vulnerability. On all of these grounds, it is a very clear 0-0 win.
Thank you, Diallo. With this, I would like to welcome the member of government to start closing government case. Here.
Just a second to set my timer. All right, I will be starting speech in the backward count of 3, 2, 1. Quick roadmap of my speech. I will be first responding to the main push by OO. Secondly, I will be giving my arguments combined with my rebuttals, and then I will be closing. But before starting, let me respond to that push, which is that there will be unequal distribution of power in these countries. Why is this not possible, though? Because each BRICS nation would have an equal voice in a common currency. This is because the bloc operates itself on a consensus-based governance model, which ensures that no single member can unilaterally dictate policy. But secondly, we see that there are institutional safeguards such as an equal representation monetary council, a joint approval for interest rates. There is a reserve management as well, which prevent dominance by larger economies like China or India. Additionally, the bloc's diverse economic composition, with each member controlling separate sectors we see, like energy, agriculture, agriculture, manufacturing, and services naturally balance this influence. Now, since I've answered this, on to my first contention, which is that a common currency neutralizes the tariff costs and neutralizes the tariff costs. Now, why do I believe in this? Because trade barriers are not just about tariffs at the borders, right? They're about hidden currency costs as well. I will be explaining this by the fact that the BRICS is a common currency which does not just eliminate conversion fee, it fundamentally shifts how members navigate global trade. But why is this true? Because even when tariffs are low, BRICS members pay an additional invisible tax through exchange rate volatility and dollar-dominated transactions. And that is where your core reserves do not work right that you mentioned.
Point of
Even
information.
with massive reverse, not right now. Even with these massive reserves, BRICS members still face this exchange rate volatility when trading with each other or even with the West. But why is this bad? Because when the dollar strengthens, the BRICS currencies suddenly face import inflation, even if their domestic economies are stable. But note that a BRICS currency allows these members to trade internally without this dollar exposure, shielding them from imported inflation. Meaning, let's take an example. So, for example, if Brazil sells soybeans to India, they must first price them in dollars. A single Fed interest hike can suddenly make the Brazilian exports uncompetitive, which functioning like a tariff even when none of them exists. But second layer then on how a shared currency allows BRICS to set tariffs and trade policies independently of US financial pressures. Because currently the tariff policies are undermined by dollar volatility. With the BRICS currency, tariffs become real, predictable, and enforceable. But thirdly, tariff reduction within the BRICS becomes far more impactful when paired with a common currency.
Point of information.
Understand that when BRICS members don't badger me, understand that when BRICS members face external tariffs from the US or the EU, they need to trade more with each other to cushion the blow, right? With a common currency, the internal trade flows freely, which helps these members to reroute the exports, the imports inside the bloc, and which reduces their vulnerability to Western tariffs ultimately. But the impacting now on how this creates stronger BRICS trade networks, this shields the US and EU, that EU from like trade policy, from from chaos, and the BRICS becomes, and also ultimately the opening told you that this is about dollar dependence. We are telling you that this is about much deeper. This is about tariffs. This
Point of
is about trade
information.
sovereignty, which becomes fundamentally transformed. Second argument, this starts with a rebuttal to OO about why cold reserves don't work. First of all, cold reserves are passive and currency here is active because BRICS billions in cold reserves are basically insurance. A common currency, by contrast, we see it is structural, it is proactive. It changes how trade, finance, and investment flow internally and externally because reserves can only respond when a shock hits. After it hits, a currency prevents some shocks altogether from happening by removing then after that, my second contention on how a BRICS currency acts as the ultimate geopolitical weapon. I believe in it because obviously money is power. A BRICS currency is not just about economics, it's a geopolitical tool that lets members project influence and protect themselves in this hostile world. But firstly, let me respond to the fact that there may be more sanctions by other Western countries in three responses. First of all, that retaliation is already limited because the BRICS economies are already large, they are diverse. The West cannot impose sanctions without hurting themselves. B, that launching a currency sends a credible signal of resilience, discouraging retaliation because the West knows that the BRICS is coordinated. And C, the more the West attacks, the more BRICS trade internally strengthens itself and becomes more self-sufficient. But my first letter to my argument is how this creates more technology because a BRICS currency cannot survive on traditional banking members because they are too diverse in size and financial systems. To make it work, they must build digital payment infrastructure, blockchain settlement systems, and interoperable cross-border fintech platforms from scratch. This means that the BRICS does not just catch up with finance; it leapfrogs it because it skips these legacy systems like SWIFT, etc. Right? And B, on how once this infrastructure exists, it does not just stay confined to these central banks; it splits into daily life. This looks like cheaper remittances, which are crucial for India, for South Africa, for Brazil, where millions rely on overseas remittances. But B, also that mobile payments and microfinance access also grows because common infrastructure enables millions of unbanked people in rural BRICS regions to plug directly into digital fintech. But see that local fintech ecosystems are now growing around these rails, creating new startups, new jobs, new services just because of this new currency. But why is this only exclusive to our side? Why can't you do this with any other way? Because if BRICS does not launch a shared currency, none of these infrastructure incentives exist. Individual currencies have no reason to build interoperability on their own, and even if they do develop, they remain fragmented, right? And only a common currency project forces this coordination for harmonized payment standards. Our argument are most critical because they go beyond opening government's focus on basic trade gains and
Thank,
dollar dependence. Instead, we show how BRICS common currency restructures the foundations of economics, technology, and geopolitics. With this, I would like to end. Thank you.
Perfect. I thank the speaker. I welcome the next speaker from CEO side here. Hi, do we have the next speaker, please?
Yes, am I audible?
Yes, you're perfectly audible.
All right, just give me a moment to organize my notes. All right. The central burden of government bench throughout this entire debate was to demonstrate uniformity between BRICS member states' economic conditions in order to make the adoption of a common currency viable. Insofar as we have heard concrete reasoning from OO and essentially no responses of why they are uniform, we tell you that global players such as China and Russia will always dominate the monetary policy of a BRICS common currency. 2 points of unique extension in the CO case. Firstly, on how the adoption of a unified BRICS currency directly harms smaller countries within BRICS, and secondly, on how it results in lesser international trade due to the threats posed to dollar hegemony. But firstly, on the adoption of a unified BRICS currency harming smaller countries. The setup here is that the ability to punish BRICS countries for predatory behaviors is significantly reduced after the adoption of a common currency. We tell you as now, if you are to sanction a BRICS country, it is made more hard as there are now, yes, because there are more countries to sanction because they all use the common currency. The change here is that the national interests of countries do not change due to this common currency. There's still the selfish interests of juggernauts like Russia and China who want to take over other countries, who want to launch wars of aggression. And what this leads to is the simple inability to reprimand rogue states such as Russia and China, which means that you can't sanction one as the sanctioning of one is the sanctioning of five. This precisely leads to greater reluctance of the international community in reprimanding the states themselves as they do business with more than, for example, just Russia. Now, if you want to sanction Russia, you need to sanction China as well. So this is especially contextually pertinent in the current Russo-Ukrainian war. This looks like the inability of other countries enforcing BRICS to or Russia to devalue the ruble, which has been happening now, which has caused devastating impacts on the Russian economy. The Russian economy itself is now much smaller. The war has taken much more out of Russia precisely because of these sanctions, crippling the Russian army from continuing to invade. So that is what we tell you that's made harder now that BRICS adopts a common currency. But notice that this impact is made even worse if the sanctions are put on anyway because of the effects to smaller countries. We tell you that smaller countries which are interloped with these bigger countries who make these aggressive decisions and bad decisions have no buffers like big countries do, meaning that you don't have these stores, you don't have the government bonds to bail you out. So we tell you that the economic volatility is now detrimental to smaller countries and will harm them in like disproportionate ways, which big countries do not consider for when they attack smaller nations. I'll take the POI.
Why does the European Union common currency work and we're still able to have sanctions against them, but it won't work for BRICS?
because of the lack of uniform decision making within BRICS itself. BRICS consists of geographically diverse and very differently interested nations. They have much different interests. The Europeans all have one continent, they have one goal, and they are broadly united. This is not true with BRICS, which spans multiple continents of South America, Africa, and Asia. This is just a completely different case. But then moving on to this idea of lesser international trade, here I'll flip some of the OG analysis on how the BRICS ties are being strengthened and how the strengthening of ties suddenly leads to like the decrease of tensions. But what I'll tell you is that this actually leads to the heightening of tensions on the global context. Why is this? The current geopolitical tensions, which is caused by like the adoption of a common currency, will disallow countries from trading between each other. That is to say that the US sees the immediate threats of BRICS currency posing a direct threat to dollar hegemony. This means that any trade that happens between BRICS and the USD and countries using the USD is unlikely to happen unless they leave the currency union. So Brazil is not able to trade with America. So what we tell you is that, but this does not only apply to the nations directly involved in BRICS and the US, because this also affects neutral countries. Countries which trade with both BRICS and America cannot do so anymore because of the pressures the US will levy on these countries to choose a side, to create a false dichotomy, to create a dichotomy of either you trade with us or you're against us, because BRICS poses a threat to the dollar hegemony, which places neutral countries in the crossfire as well. The change here is that when you do not have this, when you have the hegemony of the US dollar, you have the better ability to further global trade. You have specialization and the comparative advantage because countries no longer have to produce everything. You have cheaper products because you can simply import things, and you have better integration. The flip of what OG tells you about how, BRICS countries are better able to collaborate with each other, but we tell you that on the global stage, you're better able to collaborate with each other. And because of this weighing, because we precisely weigh over both government benches,
Fine.
very proud to oppose.
Perfect. I thank the speaker for a very fine speech. Go to summarize the offside case here.
Can I take my 1 minute of prep time?
Yeah, sure. You can take 30 seconds.
Okay, thank you. I would like to begin my speech on the reverse count of 3, 2, 1. Panel, today I'm going to demonstrate why CG clearly takes it over every single bench. Let's start from the OO then. The OO literally opened their case talking about emergency liquidity and other existing mechanisms, which directly points to the fact that there are mechanisms that already exist within BRICS which clearly have not worked. The entire world, specifically countries within BRICS, are forced to rely on USA. They are forced to depend on other nations, which is why there is a clear need for a common currency. OO talked about how different countries have different policies and different economies without understanding that adopting a common currency does not require them to follow the exact same model within their countries. Unified currencies does not equate to unified policy. This is something opposition as a whole completely failed to understand. Different countries can still budget separately despite having the same currency. OO also talked about contentions between India and China, which shows their blatant unawareness of geopolitics, considering that India's ties with China are literally growing stronger, right? So we don't really see how that comes into play here. Their push on policy deadlocks already exist in the status quo. These disagreements between India and China, and say Russia and India, have not led to BRICS' failure yet, and a unified currency is going to enhance trade. It's not going to all of a sudden create circumstances in which policy deadlocks is going to cause failure. Also, They talked about how members can't adjust interest rates or handle domestic crisis, but we think it's silly for them to believe that upon the establishment of a unified currency, BRICS is not going to have a stabilization fund. We think it's imperative for them to set up such a fund so that if one country has some sort of inflation, like for example, if Brazil is undergoing inflation, they can use this fund to pay off, right? They also tried to talk about how tariffs and sanctions will increase because of increased exposure and targeting, which we think is like shooting themselves in the foot, because their mechanism was reliant on how going against the US dollar directly leads to tariffs, which just tells you how much we need a common currency. Secondly, when these countries join together, it's obviously much harder to sanction them, right? Because the entire point of sanctions negatively impact both the imposee and the imposer. Here, if for example, if USA were to impose sanctions on Brazil, it would literally only negatively impact USA, because now they can no longer trade with Brazil. But Brazil has like
More
they can trade
information.
with everyone in blocks, which is why they will not face economic harms. Yeah, I'll take your POI.
Even if a common fund is symmetric, how does that help when a domestic crisis, say inflation in South Africa or a commodity crash in Brazil, requires immediate monetary action, but under a common currency, those government can't devaluate or
Yeah.
set interest rates on their own?
Thank you. I got your question. When I'm talking about a common fund, I'm talking about a stabilization fund, which literally exists for such a situation, right? So when BRICS comes together and keeps money aside for stabilization, that money will only be used in case of domestic crisis. Anyway, OO also talked about commodity backing and how that's going to amplify deflationary pressures. But this is just factually incorrect, because commodity backing does not automatically create deflation. It literally provides stability and predictability for the currency, as seen in China's SDR. They brought the question, why will BRICS currency be
More
accepted over the
information.
dollar? I'm not taking any more POIs. And this is a question OG couldn't answer, but we tell you that increased trade between BRICS will kill dependence of USA, which would then inspire other countries to trade with the BRICS, which directly benefits since they now have more trade options than just the USA. The most bizarre push that we see on OO is that were the ones to point out China, because the most bizarre push was that industrial growth won't occur. This is something we find ridiculous, because OO were the ones to point out China's excellence in manufacturing and India's service-based economy and the different industries the BRICS literally controls. Once they adopt a unified currency, of course, trade within the bloc will grow, which will naturally lead to industrial growth. Now, on to my responses to CO. They talked about how Russia and China will dominate since they are now harder to place sanctions on, again, directly contradicting OO. But let's understand that countries within BRICS can still exit and choose not to support China and Russia's actions if they were to choose a violent path, which is something countries like India and Brazil are unlikely to support. CO also talked about how there are conflicting interests among countries in BRICS, which again already exist in the status quo but are taken care of. They claim that smaller countries within BRICS will be negatively impacted with literally no mechanism, a repeat of OO's argument, which we already took care of, right? But one new push that we see on their side is that less international trade will occur because countries are forced to choose between USA and BRICS. What they don't understand is that in the status quo, you aren't given the privilege of a choice. You are stuck with the USA. They talked about dollar dependency like it's a good thing, but they fail to understand that when you're forced to trade with one country, you're giving that country unchecked power, and they don't understand the way USA just throws tariff threats like it's something they can do. The reason we take it over OG is because even though they talked about de-dollarization and bargaining power, they didn't talk about the advantages that developing countries will reap, which is something we directly talked about. We talked to you about fintech startups. We talked about countries, all developing countries. We talked about economic growth. We talked about industrial growth, which are points they failed to cover. This is the reason I think CG takes a clear first. Thank you.
Perfect. I thank the speaker for a very fine speech of WIP to conclude the debate. Thank you, everyone. Of WIP.
Okay. Right. I'll begin my speech in 3, 2, 1. the key strategic error made by every single team in this round except us is that they are forgetting the biggest conflict that is happening right now, which is the Russia-Ukraine war, and focus on meaningless things. More on this later. Why do we outweigh every single team in this debate? First, on OG, they tell us how we're going to be less dependent on America. Firstly, not much impact given, so I'll ignore this. The main thing is that the inter-country trade is going to be improved because of interest rates. The thing is, we still have some sort of inter-country trade between BRICS, even if it's inefficient because of the costs. But on their side of the house, they have no trade at all from countries outside of BRICS. Why is this? Z already told you this, right? Firstly, they're afraid of adopting a currency that is being devalued because of Russia, firstly, and secondly, is being tariffed by their allies, so they're afraid of being ostracized by their allies. So they're unlikely to convert to BRICS to trade with these BRICS countries. We may lose some inter-country trade within BRICS, they lose all trade with all international person. They told us about personalized interest rates. All right, the idea is that, like, they say that the thing is, negative effects on currency is significantly greater on our side of the house, right? Because even if smaller countries like others, even if smaller countries don't get it personalized, firstly, like, it's somewhat similar scenarios for all these countries. And secondly, bigger countries still have to somewhat listen to them for not giving them, still have to listen to the smaller countries so they don't join Western blocs. Z is the one that told you why it's going to be uniform, and so they cannot claim that mechanism. Notice that. So the thing is, on our side of the house, Western countries do not care at all about these smaller countries in BRICS and just want to end Russian aggression ASAP. So that what that means is that they're more likely to tariff without caring about how they're going to end up in the last place. Why do we outweigh CG? They tell us about how it's going to be less vulnerable to EU tariffs, right? I mean, less vulnerable to tariffs overall. The thing is, even if they're less vulnerable, all this means is that this just forces them to place higher tariffs. There's no reason why they can't place higher tariffs. And the thing is, even if, like, the bigger countries like China are going to be less vulnerable to tariffs, we simply say we do not care. Why is this? Because China has an economic buffer. India, all these countries have a massive economic buffer that no matter how much you tariff them, they're still able to operate well and good. Or the problem on our side of the house is when you tariff these countries that have one currency, you automatically tariff these smaller countries like Ethiopia, which does not have the same level of economic buffer. And what that means is you devalue their currency, and therefore you lead to the tariffs negatively affect countries that have nothing to do with any conflict. You try and tariff China, even though they'll be fine with it, you tariff a country that you end up tariffing a country that will face massive consequences. But notice that you can ignore every single thing I've said so far, and we still outweigh everyone in this debate. Why? It's because we decrease the ability of Russia to wage war in the US because we can easier devalue the ruble. Saving lives is infinitely more valuable than any single impact that has been brought forward by any team here, and therefore we claim that. So on to, like, what our substantive is, because I think CG misunderstood this. What we talk about is that it's more capacity to devalue the ruble. In the status quo, we have a good method to tariff them and, like, decrease Russian aggression and devalue ruble by just tariffing them. But when you have a scenario in which they're tied to this massive chain, it's so much harder to tariff them because, one, you don't want to put massive tariffs on India, China, or whatever because they trade with you so much, and so the ability to tariff them is decreased. This directly leads on to our second substantive that, like, when you do end up, like, increasing the tariff so much and end up, like, tariffing them to a smaller extent than what we have in the status quo, that smaller extent is going to affect the other countries that are part of this, that are part of the BRICS. I think I've mentioned this already. So why do we, just some rebuttal on what we've heard from the opposition teams. Both of them talk about the reduced dependence on the US dollar, right? Like, why is this not going to exist and instead increase on their side of the house? Like, countries don't really trust BRICS right now, right? Especially because Russia is in there, and this is a country that is, like, being devalued by everyone else. Therefore, they're pretty unlikely to convert in the first place because these countries are tariffing, and they're just going to deal with the dollar anyway, or not deal with them at all. In fact, this is flipped because on our side of the house, in the status quo, you can instead trade with currencies like the yuan and the rupee, but in their side of the house, these currencies are completely locked out because you can only trade with this BRICS currency that people are inherently unlikely to trade with because Russia is part of it, and Russia is facing massive, massive sanctions from the West. And what this means is that you, in fact, get less trade on their side of the house because you do not have the ability to trade with these countries like the yuan and the rupee, and that is why I couldn't be prouder to propose. Thank you. Oppose, sorry.
Perfect. I thank the speaker for a very fine speech. With this, we come to the end of the open finals. I asked teams to virtually cross for shake hand. And yeah, thank you everyone for a wonderful debate.